Want to avoid getting wrecked in crypto in 2025? In an industry known for its extreme volatility, keeping your crypto holdings secure can feel overwhelming, but it doesn't have to be a gamble. Let's dive into how you can protect your crypto investments and the do's and don'ts to optimize your returns in 2025. First off, be reminded, cryptocurrency can be extremely profitable, but it's also very volatile and risky. You've probably heard stories of people making millions and then losing it all in the blink of an eye. So what's the secret to not getting wrecked? 1. Do not FOMO into coins. Fear of missing out, or FOMO, is one of the biggest traps in crypto. When everyone's talking about a coin, it can feel like you have to buy. But here's the thing, markets often pump when they're overhyped and the crash follows quickly after. Take a step back and do your own research. Ask yourself, do I actually believe in this project long term, or am I just riding the hype train? Trust your research, not the chatter on mainstream news and social media. 2. Diversify your portfolio. Another mistake many beginners make is putting all their money into one coin, thinking it will be the next Bitcoin. But remember, Bitcoin success is rare in cryptocurrency. Instead, diversify your investments. A healthy crypto portfolio includes a mix of the more blue chip coins like Bitcoin, Ethereum, Solana, and a few promising altcoins with strong use cases. Diversification helps protect you from massive losses if one coin goes down. 3. Avoid leverage and margin trading. Leverage trading can seem tempting because it promises larger profits, but it also amplifies your losses. One small price swing could wipe out your investment. Especially for beginners, it's safer to stick with buying and holding assets. As you gain more experience, you can consider more advanced strategies, but for now, keep it simple to avoid risking too much. 4. Use stop loss orders. Stop loss orders are your best friend when the market gets volatile. A stop loss order automatically sells your crypto at a specific price which you set, protecting you from bigger losses if the market drops suddenly. Setting your stop losses helps keep your emotions in check, and it's an easy way to automate your risk management. 5. Keep track of market trends. Crypto moves fast, and if you're not staying updated, you can miss out or get caught in a bad trade. Follow reputable sources for market news, like crypto analysts, white papers, and Twitter profiles of trusted and renowned experts. Pay attention to market cycles, trends, and major industry events. This way you can avoid big price swings or be ready to take advantage of opportunities. 6. Avoid get-rich-quick schemes. Crypto can also be filled with scam projects promising huge returns. If it sounds too good to be true, it probably is. Stay away from tokens that have no clear use case or technical backing. Stick with projects that have solid teams, real-world applications, and a clear utility. Do your due diligence before investing. 7. Never invest more than you can afford to lose. This is the golden rule of investing in any asset, not just cryptocurrency. The crypto market can be unpredictable, especially for beginners, and it's important to only invest money you're prepared to lose. By managing your risk in this way, you'll reduce the pressure of watching your investment go up and down, and you will avoid making panicked decisions. So if you want to avoid getting wrecked in crypto in 2025, take a strategic approach. Avoid FOMO, diversify, stay informed, and manage your risk. Crypto can be a great way to build wealth, but it also requires patience, discipline, and intelligent decision-making, all while controlling your emotional impulses. If you found these tips helpful, make sure to hit that like button, share with others, and don't forget to subscribe for more crypto content here at Crypto King. Stay safe, stay diligent, and see you in the next one.